Hey guys, it's Richard. You're watching The Plain Bagel. I hope this video finds you healthy, safe, and doing okay financially, because it's been a rough few months, needless to say. Obviously, a lot has changed since the last time we talked about COVID-19. We now have roughly 6 million cases around the world of COVID-19 confirmed, and sadly around 360,000 deaths tied to COVID-19. And we're now seeing the economic impact that COVID-19 is having on the world economy. Unemployment in April in the US hit 14.7%, its highest since the Great Depression, and in Canada we hit 13%, showing just how many jobs have been truly lost because of either temporary or permanent layoffs tied to lockdowns trying to prevent the spread of COVID-19. And according to many international authorities on the matter, we are now in a recession, both nationally and globally across the world. And for a lot of people, this is a really scary time. Not only are millions of people losing their jobs and getting sick, but for young investors, this is really the first downturn we've seen, the first recession since the 2008 financial crisis. Since then, we've had the longest bull run in US history, and the economy, while there have been some problems, has been growing very strongly. So for anyone with money set aside for retirement, or people who have put a lot of their wealth in the stock market, it's a really scary time, which is why it's particularly strange to see that stock markets have been rallying over the past few weeks. In fact, if you look at the S&P 500 and the S&P TSX composite, you'll see that as of February 19th, around when the indices were at their high, the two markets are only down 9.9% and 14.7% respectively, meaning that the indices are roughly in line with where they were in March, when the US had under 300 reported cases of COVID-19. So for some people, that might make you optimistic. You might think, wow, obviously with states now opening back up, stores reopening, and restrictions being pulled back, maybe we're finally in the clear. But alas, it's not that simple. The truth is that we're likely going to be dealing with the consequences of COVID-19 on the economy for quite some time yet. It doesn't necessarily mean that things are going to be getting worse, but I wanted to address the optimism that we're seeing in the stock markets and discuss why it might not necessarily reflect the situation that we're currently in. So in this honorary party pooper video, I'm going to be providing an update to my previous COVID-19 video, which was posted in early March, since when a lot of stuff has changed, to discuss the stock market as a whole and just frame the situation that we're currently in. It's not going to be telling you whether now is the time to invest or sell, but hopefully it will give you some insight into the markets and the situation we find ourselves in. Now, the first thing I want to address in this video is the difference between the economy and the stock market, because a lot of people kind of assume that they're two sides of the same coin, which is not entirely false, but the two don't necessarily move with one another. So far in 2020, we've seen a wave of just terrible economic news. The European Commission recently came out to say that they're predicting the EU's economy, so the economy of all the member states, to contract 7.4% in a recession of historic proportions. Meanwhile, the IMF is expecting Canada's GDP to contract 6.2% and the US economy to contract 5.9% in 2020. Now, on top of this, a lot of economists are coming out and saying that they're expecting the second quarter of 2020 to be the hardest hit for the year. For example, in Canada and the US, GDP is estimated to fall at an annualized rate of 15 to 35% in the second quarter, which raises the question of why, even though we're expected to be in the hardest hit quarter of 2020, we're right now in the middle of the second quarter, why stock markets are rallying. And it really comes down to one point, which is that the stock market is forward-looking. The initial drop we saw in the stock market back in March really came down to what investors were trying to predict COVID-19 would do to their stocks. Any rally since then has effectively been a reaction to new information about what's going to happen in the future. So even though we're currently in what's expected to be a really bad quarter, investors aren't buying and selling based on what's currently happening. They're looking to the future as to what things are going to look like a year from now, or in some cases, even just a few months. So what has happened to make stocks rally? What is this positive information coming to light? Well, there are a few things worth highlighting. The first is that even though we're seeing one of the fastest contractions in the economy, for April, unemployment actually came out better than was expected. Some people were expecting unemployment of 18 to 20% in the US. So to see it come in at 14.7%, while still obviously negative, is better than what some people expected. But probably a bigger factor, or a contributing factor to that, is the government stimulus that we've seen. In Canada and the US, we've seen stimulus packages in the billions and trillions respectively to support individuals, to give money to Americans and Canadians, and to help businesses stay afloat, to give them loans and grants to keep them from defaulting because they aren't able to earn revenues at the moment. On top of this fiscal stimulus, the Federal Reserve and the Bank of Canada are expanding their quantitative easing programs, meaning that they're inserting themselves into the market as buyers, mostly for bonds, but in some cases they may actually be directly buying stocks. This is something that directly boosts lending activity and will improve stock market valuations, even if it sticks to just bonds, because it makes lending easier, makes it easier for these companies to get loans, and it will support their valuations. So that's the main reason why stock markets have rallied since their drop in March. The government has stepped up to plate and introduced a lot of stimulus to support businesses, and the central banks have been directly supporting financial markets. Both things that, from the investor's perspective, lower risk and improve confidence. But the truth is that even if stocks recover all of their losses, it doesn't mean that we're out of the recession. Again, the two are separate entities. They're related, but they measure different things, which raises the question of, even with stock markets rallying, if we're not yet out of this recession, how much longer is this going to last? And the truth is that there's no way of answering that. Historically, according to the National Bureau of Economic Research, recessions have lasted on average 13.3 months, and the median length has been 10.5 months. So recessions have typically lasted around a year. On top of that, the range of how long they've lasted has been 6 months, which was the 1980 recession, to 43 months. So under 4 years for the Great Depression itself. But it's very difficult to take these stats and compare them to our current situation, because this is really the first one in that data series that's being caused by a pandemic. The truth is that this downturn could last another 3 months or another 3 years. Some people even think that we might see a depression come from this. I've seen a lot of comments on my Great Depression video calling this Great Depression 2.0, which, the hold my beer meme is only funny so many times, guys. But even though we can't predict how much longer this will last, let's discuss the factors involved with the duration of this recession so that we can still put it into perspective and frame the situation. First of all, it's worth highlighting that how long this downturn lasts and our recovery will really come down to two main factors: further developments around COVID-19 and other government action. To the first point, obviously this downturn is being caused by COVID-19 and the resulting lockdowns that are being introduced to prevent people from spreading the disease further and to save lives. Because of this, we're not going to see a full recovery, or at the very least a full rollback of lockdown restrictions, until we've seen further drug development or the development of a COVID-19 vaccine that's become widely available to the masses. Many experts are saying that we're not going to have a vaccine that's available and safe until 2021. Possibly late 2021 when it can actually be distributed to the masses. To the second point, obviously the Canadian and the US governments have really stepped up to plate with their fiscal stimulus. But there is a chance that these governments do impede future economic growth with their current spending. For example, debt to GDP in Canada is expected to reach over 100% because of the current stimulus measures. And in the US, it's expected to exceed 120%. Now, this debt does appear manageable because of low interest rates, but we do need to pay for that debt at some point, and that could mean higher taxes in the future or spending cuts, which, if timed incorrectly, could make our recession worse. But on top of that, we also need to consider, lockdown provisions. We've seen a lot of states starting to roll back their lockdown. There is a chance that we see a second wave of COVID-19 if those actions are premature. I'm not one to judge. I know that's a complicated and controversial topic at the moment. But it is a risk that we need to consider when trying to figure out how long this downturn could last. If we do see a second wave of COVID-19 cases, it's going to prolong this downturn. And the other thing to consider is the shape of our recovery. You might have seen this, but many economists are debating, what our recovery is going to look like, with three scenarios kind of being purported. There's the V recovery, the U recovery, and the L-shaped recovery. The V recovery is the best case scenario. It's effectively a bounce back from our lows. Because this is a pandemic-caused recession, the thinking is that with government lockdowns and government stimulus, we're able to pause the economy, and when the COVID-19 pandemic is dealt with, we can resume operations to where we left off. We went into this with very strong consumer sentiment and strong business activity. So the hope is to kind of put that into a medically induced coma, which is an analogy that's been used quite a bit, and pull it out of the coma when things are better to resume where we left off. At the polar opposite is the L-shaped recovery, which is really the depression situation. It's where we see a drop and then things remain depressed for quite some time. That could result if companies lose their confidence with their investment activity because there's uncertainty around COVID-19 and when these restrictions will be lifted. Companies might spend less, and that might lead to less employment, fewer projects, and fewer growth in the economy. Now, for better or for worse, the L and the V-shaped recovery aren't likely. They're more of the goalposts that the actual scenario is likely to fall within. And that's where the U-shaped scenario comes in. It's a gradual recovery from the steep decline. One that isn't instantaneous, but fortunately does bring us back to our previous levels. Now, it's unclear how long that will take because, again, we can't predict what will happen, but it gives us some idea of what we can expect with our recovery from COVID-19. So hopefully that information helps you put this current situation into perspective. We don't know how long this recession is going to last, but there is some information we do know about how things might turn out. And I know that all of this is a fairly sobering discussion, especially when you put it in contrast with the stock market rally, which may have convinced people that we're getting to the end of this downturn. The truth is that's probably not the case. But the point of this video is not to convince you that things are going to get worse or, that they're going to get better, but just to kind of rein in any overconfidence people have about what's going to happen with the stock market and the economy as a whole. I've seen a lot of comments of people trying to predict what's going to happen. People saying that this is going to be Great Depression 2.0, or that this is going to recover very quickly. But there's a lot of uncertainty here. On the one hand, this is one of the only recessions that have really been largely self-imposed. That might be a net benefit, it might be a net negative, but it's different and it's hard to take into account and predict what's going to happen given those factors. And in the world of investments, the wise investor is one who realizes what they don't know and acknowledges that they can't know certain things, including the length of a downturn and how bad it's going to be. Investing is about taking a measured approach, not looking at things as being binary of, oh yes, we are going to have a worse recession and I should sell everything, or, things are better from this point forward and I should go all in. And to end this video on a pretentious note, I want to wrap up with a story about Socrates, the philosopher. Yeah, I do have my head up my own ass, thank you. There's a story about how Socrates was once called the wisest man in Athens by an oracle. And rather than gloating about it, he tried to disprove the oracle. He tried to find someone who was more wise than himself. So he went around town asking people a question of what was truly most worthwhile in life. Because he figured if someone could answer that question, then they would truly be more intelligent or wiser than himself. But everyone he asked gave him unsatisfactory answers. What he found was that people were effectively making stuff up, trying to sound intelligent about a topic they clearly knew nothing about. And in the end, he realized that he may very well be the wisest person in Athens for the simple fact that he was the only person willing to admit that he was ignorant on the topic. And I think that's something that investors should take away from this video. Be like Socrates, be humble, and realize that there are some things that we simply can't predict, that we can't forecast. So it's better for most people to just focus on their risk tolerance, take positions that are appropriate for them, and, be like Socrates. So that's the video, guys. I hope it finds you well, healthy, and financially doing okay. I know it's a tough time. I know it's a scary time, but hopefully this video gives you a bit of solace, and while at the same time reining in any overconfidence you might have. If you like the video, make sure to like, subscribe, bell icon for notifications, and comment down below your thoughts on the current downturn and what you think might happen and how you're preparing for it. Thanks for watching, and as always, be safe out there.